And if you look at the Nifty, you'll be deceived for thinking that there is a lot of other participation for this 1% move. But it's predominantly the Nifty Bank. Look at this move today. And this is being led by ICICI Bank, yes. But that's the power of what banking can do to the market sentiment. It's not that everything else is hunky-dory. So frankly, ICICI Bank up 4.5%, doing great. Bring up the mid caps and the small caps, and you will, relative to the bank Nifty, you will see the distinct difference. 0.35% for the mid caps. Small caps will come up on your screen flat. So there is hardly any change at that end of the market. It is predominantly what's happening to the bank Nifty in the session today. The Nifty contributors list will come up on your screen, and you will see ICICI Bank right up there, but it's all banking. It's effectively all banking, which is contributing to 247 points on the upside, and a few others that have come off. UltraTech on results, Apollo Hospitals again on the development, but a few and far in between, really. It's essentially this end of the market that we will be talking about with our guests in the session today as well. Splendid show from banks. Just get the heat map up. It'll effectively show you the same thing. No big changes there about ICICI Bank, SBI, Axis, etc. Bharti Airtel is up about 1%, Tech Mahindra, TCS in the green, HCL Tech on the other side, Apollo Hospitals lower. HDFC Life has some issues to itself in the session today, but two-wheeler stocks okay. Last but not the least, the BSE 500 list will come up on your screen. The top winners and losers on the BSE 500, and beyond banking, Supreme Industries, after the surprise that they delivered on the numbers, up 11%. Tejas is up 7.5%. Rucha, my colleague, did a whole piece on Friday about what's next for Tejas. Remember, that stock is up. There is strength in Jamna Auto today. KPIT ahead of the numbers is up 6.5% today. Or maybe post the numbers. HCL Tech down though, but Spark, just watch out for this one. Today is an interesting day of trade simply because a lot of blocks have happened in Spark. Could be nearing the end of the downtick that we've seen in Sun Pharma Advanced Research. So that's to be watched out for. Mahindra Life, we'll be talking to the management in a few minutes from now. He's down about 4% as well. Hemen will be joining us in moments from now. And if he's here, we should try and go to him. But the thing to ask Hemen Kapadia would be about what is it that the Bank Nifty will likely throw up over the course of the next few days, and will it be a Bank Nifty dominated move, or do we have other sectors participating? Because today it is unequivocally about the banks. Hemen, thanks so much for joining in. Really appreciate your time. Did you anticipate such a move on the Bank Nifty today?
Frankly speaking, a very good afternoon, Niraj. Thank you for having me. No, I did not. A move, yes, but of this proportion, I don't think so. Because, Niraj, it's been a question of crying wolf. Because last time the Bank Nifty broke out from its all-time high, we closed above it for a couple of trading sessions, and then we collapsed 2,000 points, 2.5, and now we are back again. So frankly speaking, no. So this time, I believe the breakout, I mean, I was bullish last time, if you remember, Niraj, but it didn't exactly work out. But this time around, I believe this is a real thing happening. But no, the move today was not very surprising, but surprising nevertheless. Hopefully these levels sustain till Friday. We've opened the doors for 52 or so, Niraj. So setup is positive. The VIX continues to be a bugbear. Didn't need to see the VIX go up like this, but I'm not sure. Maybe there's something else, geopolitical, political, or whatever. So yeah, it looks good. Bank Nifty is leading, and I believe the PSU index has broken out. Nifty, PSU Bank Index, Niraj, I think there is distinct more upside. I'm not sure it's going to move in the same vein or in the same quantum at the speed that we are seeing today, though.
Okay. So, Hemen, what is the trade then? Are you, I mean, sorry if I missed it, but are you initiating any fresh trades on the Nifty Bank part 1? And are there any other stocks that you are recommending today?
Well, frankly speaking, on a decline. I mean, it's been on a one-way roller coaster, not a roller coaster, it's on a one-way ride, the Bank Nifty. For whatever reason, if there is a mild correction, I would say it's a clear buy on decline. That the strength is very apparent. In terms of stocks, Axis Bank is very interestingly poised. Now, this comes with a caveat. We moved up from 995 to 1164, Niraj. in a matter of 3 and 3, 6, 7 trading sessions. If it goes up one way, I would be a bit reticent in telling you let's go long, but the setup is such. It's taken 5 months, Niraj, to consolidate. 1300 is coming, no doubt about that. Only thing, it would misfire if the market failed miserably and we'd see an overall meltdown. That doesn't seem on the horizon at all. So Axis Bank is going to 1300. So one can say, and it's another almost 3% up today. So 1150, 1125, and 1095. I don't think 1095 is coming, but these three levels is where I would have a buy call on Axis Bank. I would split it up, 30 rupees stop loss and a target of 1300. So it's a screaming buy, but like I said, up for 7 days in a row, 995 to 1165, that's a lot. So it's a buy on decline, Niraj.
Okay, since we're talking of banks, let me quickly get in my colleague Harsh to talk about ICICI Bank, which has essentially been the key pivot on which this rally of the bank Nifty has moved ahead. And Harsh, and we're going to talk in detail about ICICI Bank with our guests as well, but Harsh, just a quick perspective, what's led to this kind of a reaction?
Well, Niraj, I want to first off talk about deposits because that's how the flow will really set in terms of the conversation. Deposit growth 20%, your loan to deposit ratio falling from 86% plus to now below the 84% mark. That's where the key positive lies. And with all of this happening, despite this, what's really happened is your margins have held up. Just about a 3 basis point decline in margins sequentially, not a bad number at all in a quarter where we've seen tons of pressure on margins. Now, despite all of this, your ROAs also have held up, and they've held up consistently in a very tight band, 2.3 to 2.4%. Best in class when it comes to some of the larger banks, very difficult to do on a 10 lakh crore plus kind of balance sheet, and ICICI Bank seems to be doing that on a consistent basis. 4.5% in a single day, not seen that kind of a move since 2021 October, where they culled out a very solid set of numbers for that particular quarter, which is Q2 FY22. After that, never seen this kind of again. So honestly, it's a very strong kind of a move that we've seen, and it's a solid one on the back of a very, very solid and steady set. Last off, I just want to comment on the credit card piece that happened, the incident that happened with regard to the leak in credit card data. They've handled it extremely well, and that's possibly the other positive, that among all the tech negatives that are coming out in the system, in the BFSI system, ICICI Bank seems to be on top when it comes to that as well.
All right, thank you for that, Harsh. ICICI Bank having a fantastic day, and the numbers did, of course, look good. Hemin, you spoke to Niraj about banks, ICICI versus HDFC on the charts. What would you like? Would like your view on that. And I also want to get your take on a Yes Bank today. Yes Bank again doing phenomenally well, maybe among other reasons that they may be a new suitor on the anvil. And news reports that SBI has, got the nod to exit its stake. So who comes on board on Yes Bank? All of these reasons swirling around. But just on the chart, how would you compare these three?
Okay, we'll start with the ICICI Bank, Tamanna. It's in an overdrive, so to speak. Consolidate move, series of progressively higher tops and bottoms, Tamanna, a very structured move. And it's leading the entire jamboree, so to speak, on the private banking space, and there's no stopping. Currently, we've had a 7-week consolidation, Tamanna, and we've broken out from there. Setup looks good. Further upside seems like a cinch. If you look at HDFC Bank, it's a different ball game altogether. Now, like we spoke about this earlier, Tamanna. Traditionally, let's say for the last 20 out of this year 2024, for the last till 2020 probably, HDFC and Kotak have led the bank Nifty, 70% private sector weightage. But HDFC and ICICI have led the entire, HDFC and Kotak have led the entire private sector bank back for 20 years almost. And now for the last 4 years, if you go to see, okay, Kotak, whatever happened right now for the credit card business, but Kotak Bank and HDFC Bank for the last 4 years have gone nowhere. Bank Nifty has gone through the roof. Axis, ICICI, and a plethora of PSU banks have absolutely gone haywire, berserk in a positive manner. These guys are continuously underperforming, and that's not going to change in a hurry. So, frankly speaking, a comparison with the HDFC and ICICI is unfair. ICICI is an overdrive, and HDFC Bank is still in the first gear, or third gear, so to speak. So, I would say go with the winner. But I spoke a little bit with Niraj, Tamanna. I think Axis Bank looks good. 5 months of a consolidation, so I think that has a 10% upside even from here. I'm not saying one way. The 7-day trading session move has been a bit disconcerting because it's too fast. But yeah, Yes Bank. We've seen a peak in 2018 of 400 plus. It's been a perennial underperformer. It's waking up now. On the long-term charts, the setup looks a bit promising, but 30 is something which we haven't closed up on the monthly chart in the last 4 years, Tamanna. So I think that will be the first longer-term technical green shoot when we take out 30. But yes, the setup does seem to be improving, but there's a difference between the cup and the lip. We've seen this happen a few times. Hopefully this time it finally delivers. Tamanna.
Since the flavor is so bank-heavy, banks of all hues, I need to ask you, Hemen, about IDFC Bank. And should I just club? I also want to know about all your small finance banks, your Equitas, your Ujjivan, that whole list which has been doing very well today. But let's start with an IDFC first.
Okay, IDFC first has been 1, 2, 3, 4, 5, 6, 7. It's the 8th month from the high, Tamanna. It's been corrective. It's been correcting. We saw 10% decline in numbers. It's been consolidating. The setup is bullish. So shorter term, maybe some of these wins could sort of slow things down. But if you have a longer term point of view, stock is probably heading towards 120. But this is a 15-month sort of a view, Tamanna. So not a very short term view. And yes, if you have such headwinds, obviously there would be a little bit of discomfort, at least probably in a short to maybe medium term point of view. The technical setup isn't bad. It's a correction in a bull market. Now coming back to the small finance banks, I think whether you look at Utkarsh or Ujjivan and a whole bunch of them, Tamanna.
Add AU also, Hemen. AU as well. Okay.
We'll start with AU then. Okay, AU has been blowing hot, blowing cold over some time. Currently, simply put, we've not only formed a shorter term bottom, we've also formed a medium term bottom. Now, on the longer term point of view, Tamanna, it's been range bound for 3.5 years and counting, going nowhere. So if it's a short term punt, it makes sense. From a longer term point of view, no, I believe the setup, the whole technical structure will take time to play out. And yeah, when you have something like maybe an Axis Bank, it looks prime picking. Maybe EU Bank has little to lose, but once again, a shorter term fund seems to be more with the offering. And the small finance bank that you said, Suryodaya, Utkarsh, Ujjivan, Equitas, all of them are looking promising. They are in various phases. Utkarsh is new, don't have too much of data. Suryodaya is in a longer term of more. Ujjivan also looks promising. So all of those, from 4 or 5 stocks, which I do look from a small finance bank point of view, all of them are looking promising.
Stay on, Hemen. So much more to talk about. We'll take a quick break. Up next, we'll be joined by the management of Mahindra Lifespace to talk about their quarterly performance and the outlook ahead.
Welcome back. We're speaking now with Amit Kumar Sinha, MD and CEO of Mahindra Lifespace. The numbers are out, and while pre-sales figures have gone up substantially, the top line has seen a hit. Revenues are down 94%, EBITDA loss at 54 crores versus 27 crores year on year. Net profit though is up 132x. Behind this, of course, is share of profit of JV and associates, which have gone up. Just to make sense and understand all of those numbers correctly, Amit Kumar Sinha with us. Mr. Sinha, very good afternoon. Great to have you on NDTV Profit. Can you take us through the key numbers? What are these JVs which have seen your net profits go up, and how do you sort of see that in light of the downturn in revenues and EBITDA losses?
Yeah, so thank you for having me, first of all, Tamanna. Let me try to explain some of the idiosyncrasies of real estate sector. So real estate works on different joint ventures. As an example, we have a large joint venture with Jaipur government. We have a large joint venture with Tamil Nadu government. So the way it works is you cannot consolidate their revenue because they are different entities, but you can consolidate their profits. So that's why, like-to-like basis, the revenue that you see is not capturing what has happened on the industrial business, but the profitability actually shows the underlying strength. In addition, what happens on the residential side is linked to the developer getting the OC, which is the sign of possession and building getting ready. That shows the completion of the project where the revenues can be recognized. So that also plays a little bit into how the revenue numbers stack up. It's a lumpy business, so some of that will happen. This is something that couldn't finish on March 31st. It'll get finished in April or May. So revenue is something that is very accounting related, is not something that most real estate companies pay as much attention. But the profitability is something that we all look at it. The pre-sales is something that we really look at it, because pre-sales over a period of time becomes revenue. So that's why you see these ups and downs on the revenue side. But as you look at the PAT,
sure,
that shows you the overall economic understanding of the
Understood. Like you said, it's a lumpy business. The street, though, maybe initially a little concerned with those top line numbers. Another thing which is I would say a bit of a challenge in the real estate space are the margins. Mr. Sinha, can you give us a sense of where you are and where you are guiding for margins as far as you're concerned, your company is concerned? I know your cost of funds have come down, but in terms of raw material inputs, etc., where are your margins and where do you see them going?
Yeah, so margins are getting healthier. The way the business works is, as you scale up, you get the leverage of your fixed cost. But the right economic way to look at in our business is the IRR. The IRRs capture in the investment that you make in the land, for example, the investment that you make in developing and constructing the building, and then the corporate overhead that support through the life cycle. So that's the IRR. IRR over a period of time gets translated into your revenue and costs and margin, which is the, as I said earlier, the accounting aspect of it. So we continue to have healthy gross margin. We continue to have a very solid IRR. In fact, after I took over last year, we have raised the guardrails for us to take any project. We target north of, let's say, 20% IRR, pre-tax project IRRs to do any project. So what you're seeing today is the project that we launched 4 years, 5 years, 6 years back. They're coming for completion. So they give you the accounting margin. But going forward, you'll start to see the convergence where we will show you the IRRs of new project that will get reflected into the actual margins. But despite the point that you made, there is a cost escalation, especially on the manpower side. There is a volatility at times in the commodity. We buy a lot of steel, cement, aluminum. All those things get captured, but we manage a very tight ship by having the contingency. There is enough linkage to raw material to the market prices so that we can actually factor those in our cost of construction. So we expect the margins to get healthier and healthier as we take the business forward.
Amit, how would the model be? Because you're launching, you're making some launches, the Thane launch in Q1 FY26, so on and so forth. You mentioned that you achieved the target of whatever 45,000 crore GDV, if I'm not wrong. You'll need some amount of capital to come in as well. How does all of this happen? Do you do this over a period of time? Does it happen via an external fundraise or does it happen via an equity fundraise? Can you share some details?
Yeah, that's a great question, Niraj. I think after I took over around the same time, May last year, one of the key things was for us to redefine the strategy for Mahindra Lifespace. And we announced our desire to be 5 times bigger than what we are. And year one, this is a completion of year one in a way. We have 5x aspiration, means 8 to 10,000 crores of pre-sales. To achieve that, you'll need roughly 45,000 crore of GDV. 1/3 of that, including Thane, is under our possession or the deals that we have signed. 2/3 is to be acquired over the next, let's say, 4 years. And that's something that we are very actively pursuing in the focus markets. To achieve that 45,000 crore total and the remaining 30,000, which is not with us, we will need to have sufficient capital. Typically, you need 15% of the capital as the cost of land. I would say 15 to 20%. So in our calculation, which includes outright purchase as well as joint development, which requires less capital upfront, we have estimated 7,500 crore worth of requirement. Half of that is available with us through our projects, which gives us PAT and accruals. We have the healthy IC business, which has been giving a lot of profits. To the first question Tamanna had asked. And we also have a very conservative debt to equity ratio. We want to be balanced, calibrated about how much debt we take, given the nature of this industry. So we might push that a little bit more, but we will not going to go all out on debt. This will allow us to fulfill 50% of the capital requirement of 75. The remaining, let's say 3,000 crore would need to be acquired through a platform or even our parent, Mahindra & Mahindra, which has designated Mahindra Lifespace as a growth gem. But as any investor, we need to demonstrate that we can execute really well. We can give them a return which is attractive compared to, as they think about capital allocation. So we are right now pursuing since the strategy is clear, we have delivered on some of the operational elements in year one. We are now in discussion with some of the external stakeholders to do a platform participation where they can come in, help us grow the business, and they share the rewards with us. We have done that in the past with 2 other private equity funds, 2 other funds. We might also scale with them. But right now we are keeping, we just started the discussion. Hopefully we'll have an update in the next set of discussions.
Okay. I mean, just one more question. You guys have set a few targets about what the group entities within the Mahindra Group should reach over a 2, 3, 5-year period. Just wanted to understand from where you are at the end of FY24, where do you expect Mahindra Lifespace to be 3 years out, right? So quarterly fluctuations on pre-sales, on bookings, etc., can happen. But annually, have you set a target for where you would be 3 years out from where you are right now?
Yeah, so I think we have set a target of, the best indicator in this business is pre-sales on the residential side. So we are saying that we will be in F28. So not exactly 3 years that you're asking, but 4 years out from where we are. Since we announced it last year, it was a 5-year plan. So F28, we want to have our residential pre-sales between 8 to 10,000 crore. And our IC business, which is a business that we are not investing. We made investments in the last 20 years. We are reaping the benefits of those investments. That will give us roughly 500 crore worth of revenues annually. So we will be, let's say, if you take it a midpoint, around 9,000 crore across our residential and industrial business in F28.
Just one last point, Mr. Sinha. A lot of your focus is on Mumbai. I believe of your GDV target, your pre-sales target of 8,000 crores by FY28, 6,000 crores comes from the Mumbai market. I just want to get your sense of whether you see a concern with too much inventory building up. Everyone wants to build in these pockets of markets. Are you seeing demand hold up as inventory starts piling into the market?
Yeah, it's a great question. And as you know, when you're in an up cycle, the outlook for the market is very different. The demand is very different. We are generally cautious about which deals that we pursue. Bombay is definitely a key part for multiple reasons. It's our home market. The price points are healthier. And as you know, there is a huge need for housing with the right set of amenities. So what we have done, Tamanna, is that we have picked the key micro markets that we want to participate in, and something that we can share in detail another time. But those micro markets allow us to balance some of the things that you mentioned, where the infrastructure development is happening, where there is commercial real estate is coming, that will mean more employment generation, where the connectivity is very strong. Those elements allow us to choose the locations that we want to participate. But the challenge in Mumbai is where you want to participate versus where the land is available is not always easy. It's a constantly balancing game to solve for where you want the land, where you have the land available. But during this quest for finding the right land parcel, we are very disciplined about our deal choices and deal decision. So we have a guardrails below which we never want to go. We are always looking for alternate business model beyond the outright purchase. Bombay, anyway, that's difficult. So you have joint development, as well as we have entered into society redevelopment last year. Okay. And we are right now pursuing 2 projects. And we get a lot of new projects coming in that direction, and we are carefully selecting and pursuing them.
All right, so that's interesting. Redevelopment is, of course, fraught with, I would say, tangles, but always lucrative in a market like Mumbai. Thank you so much, Amit Kumar Sinha, for speaking with us. Always a pleasure, and hope to speak with you once again soon. That was the MD and CEO of Mahindra Lifespaces. Just to focus on the UltraTech numbers, which are out, margin at 20%, 20.1% versus the Bloomberg estimate of 19%. You can see that slight spike at the end of the chart. On the face of it, a beat in the numbers on all fronts coming in, and we're waiting for some more of those details. A 70 rupee per share dividend is also in. Revenues have grown, not quite in double digits, but on the upper end of it. And profits are also better than the estimates, the Bloomberg estimates at least. Himen, just to get your sense on the charts for UltraTech.
Tamanna, it's in an uptrend on all time frames. Short term, yes, the medium term correction is ending. So this looks like an opportunity. Long term, we remain safely ensconced in an up move over multiple years, Tamanna. So look set for a further upside. though we would technically need to overcome this 10,200, 300 level just to add that stamp of approval saying yes, it's broken out, but looks good.
Okay. UltraTech looks good. We'll take a very quick break. We're coming back on the other side with BTST ideas. A lot more to discuss. We'll talk about IREDA, BSE, a whole host of other companies as well. Also, quick programming reminder, you will hear our interview with Nestle MD Suresh Narayanan at 3:30 today. A lot of conversation to have and you must tune in for that. We talk about Nestle's numbers better than street estimates and also the entire baby food controversy. All of that coming up at 3:30. But right now, quick break. Don't go away. We'll be right back.
Back with India market close right here on NDTV Profit, and of course the UltraTech numbers have done what they have done. But are we seeing a bit of a spike in HDFC Bank? That's the key thing. Just pull up the intraday of HDFC Bank also, and this, this is serious stuff. The Sensex is close to nearly 1,000 points, and look at that. HDFC Bank is now starting to inch up as well. In moments from now, we'll of course talk about what happens to HDFC Bank and ICICI Bank, and what could the difference be between an HDFC and ICICI, Kotak and a few others, if Kotak even comes into the realms of conversation right now. But just before we again focus on banking, because that is what is driving the street right now, let's talk about BSE. The stock has suffered the steepest single-day slump on semi-regulatory issues. It's off the lows of the day, yes, but there are issues out here. Mihika has looked at the brokerages, and she's joining us with a take of what is it that the brokerages are saying. Mihika, take it away.
Yes, so the SEBI has directed the BSE to pay the regulatory fee on the annual turnover while taking into consideration of the notional value of an options contract, and a notional value is the total value of the underlying asset the option contract is based on. Now BSE will have to pay the differential amount of fees plus a 15% interest per annum, and earlier what the company used to do, that they used to pay the regulatory fee taking into account the premium value, which is the price you pay to buy an options contract. So now if while the company is kind of taking into consideration what the kind of financial impact will be, if ascertained for the periods between FY7 to 23, approx 68.64 crores plus GST will be liable by BSE to SEBI, and for FY24 the total amount payable would be 96.3 crores, which brings the total liability to 165 crores. Post this, we also had some brokerage downgrades, with Jefferies downgraded BSE rating from a hold from a buy to a hold, price target of 2,900, which implied a 10% downside. What it said that since derivatives make up 40% of their 25 and 26 profit after tax estimates, they see a overall 15 to 18% EPS hit. Had IFL, which did maintain a buy rating, but it cut its target price to 2,550 rupees, offering a 20% downside. And they said that the only one way that they could kind of offset the one-time and the recurring expenses would be price hikes.
Yeah, well, let's see if that happens. Aditya Shah, CIO, JST Investments, with us to talk about the fundamentals. Aditya, I know we're going to talk about banking by and large. This is Niraj here. Good afternoon. But may I just take a quick check with you on the regulatory action impacting the stock of BSE today? I don't know if you track it or not, but if you do, what do you make of this? And is this a one-day carnage that we've seen, or could there be more?
No, fundamentally, first of all, good afternoon, Niraj. Fundamentally, what is happening in BSE is that the regulatory fees that they need to really pay to SEBI is now going to go up. So basically, why BSE stock was moving over the last 1 year was that there is an arbitrage in cost between BSE and NSE of about 40% on the options trade, and a lot of volume was starting to move towards BSE because of the lower costs. NSE was paying the regulatory cost at notional value. However, BSE was not paying. So what this in turn will do is, now the cost structure for both BSE and NSE will be exactly the same, which will mean that the volume shift that was happening from NSE to BSE will start to slow down, and it will have a material impact on the earnings of BSE. So in my opinion, this is a negative for BSE in the longer term. And now, since the valuation is extremely expensive, now you need to be very, very careful with BSE. However, longer term view on the exchanges remains positive as financialization of savings continues to move up. Stocks like BSE, NSE, or MCX for that matter will keep on doing extremely well.
Aditya, good afternoon. Tamanna here. I'm glad you mentioned MCX, because that's the other one that has been hurting because of regulatory headwinds. I want to extend that to the entire BFSI space. Today it's BSE and MCX. Earlier it's a host of banks actually, and financial institutions. How big a headwind do you see these regulatory interventions which keep popping in and again, and how do you mitigate that sort of challenge?
Good afternoon, Tamanna. So we have seen a bank where compliance was at the pinnacle. Kotak Bank, there also the regulator has come and given its verdict and banned them from onboarding clients to their digital platforms. So I see this as a positive, really. The regulator is telling the banks that buck up, try to invest more on your IT systems, and try to follow the regulations very, very closely. In my view, what this will do is this will elongate the credit cycle. Credit cycle used to be 3 to 4 years before. Now it will be 5 to 6 years, because the RBI is checking the unsecured loan fraud. The RBI is checking frauds that are happening in the system. RBI is checking the IT systems problem that is there. And RBI has also recently regulated the payments bank, where it thought that frauds could occur. So the regulator is stringent. The regulator has woken up from the past learnings. This is positive for the sector. Of course, in the short term, banks will have to bear the brunt of it. But over a longer period of time, this is good for the entire sector. And as they say, the stronger will become strong now. Those who've got the money and those who will comply really well, they will become strong. And those who are weaker, they will continue to become weaker.
Aditya, one of the reasons that we were keen to talk to you today is I saw an interesting tweet thread you did comparing ICICI Bank and HDFC. What struck me is that while ICICI Bank on the face of it has seen better numbers, the street has rewarded it, it's also because of low provisions and higher valuations is a question. How would you view ICICI Bank today post the movement that we've seen through the day?
So ICICI is not going a event. HDFC Bank is undergoing an event where they have got merged with HDFC, and there are a whole host of issues like the CD ratio, like the cost of funds for HDFC was higher. So they are adjusting to that new reality. Whereas ICICI Bank has got no problem. They have shifted their entire book from a corporate dominated book to about 60% of retail dominated book. So ICICI Bank is doing tremendously well. There's no problem for ICICI Bank. However, if we look at the relative valuation for both of these banks, now both of these banks have all the subsidiaries that HDFC Bank did not have before, like the AMC business, like the life insurance business, like the general insurance business. So net, if you compare both of these banks, ICICI Bank now trades at about 3.59 times price to book, whereas HDFC Bank now trades at about 2.57 times. So what this really is telling is, yes, HDFC Bank has near-term headwinds, but a bank which is making 70,000 to 1 lakh crores of profit, which has seen a margin erosion from about 4% to about 3.3%, will find over a period of time that the margin recovers as they concentrate on the retail loans. So net, I feel from a valuation perspective, now HDFC Bank is becoming much more attractive than ICICI Bank. However, from a near-term business perspective, ICICI Bank will continue to deliver stronger numbers over the next 2 to 4 quarters. After which 4 quarters, maybe 4 or 6 quarters down the line, HDFC Bank will come back with their retail loans, and their net interest margin will also come to 4%, where they will grow. So value investors should start to look at HDFC Bank. If someone is looking for growth investment, then they could look at HDFC Bank. Mind you, both of them are not really cheap, trading at about 2.5 times. HDFC Bank is trading at about 2.5 times. ICICI Bank is trading about 3.4 times.
Aditya, when do you... So a few people who might have bought into banking, considering that the valuations are very low, have been rewarded. The question only is, is this still a good time to buy into any of the private banks, or would you believe an initial knee-jerk reaction is all that was warranted and the move ahead will be labored and slow?
So I believe that first part of credit cycle is really done, where PSU banks and small private sector banks were getting re-rated. And that's what we've seen over the last 1 year. They have given massive returns. Now we are entering into the second part of credit cycle, where we've seen, even in the interview that you have taken today, that CSB Bank, IDFC First Bank, they're starting to report higher credit costs and higher slippages. So we will see over a period of time that slippages start to increase. And now there will be a quantum shift towards the larger private sector banks who have got stronger franchises and who have the ability to control those slippages. So in my opinion, now is the time to look at larger private sector bank, be it an HDFC, be it a Kotak, be it an Axis, be it an ICICI, or to some extent, be it an SBI also. So you need to concentrate your incremental investments there. If you have investments in PSU banks or smaller private sector banks, then you need to hold on to these investments. As I was telling Tamanna, that since the regulator is acting on frauds that are getting created, we will see that this credit cycle will get elongated to at least the next 2.5, 3 years. And it will be even more stronger if the current government comes back and pushes the infrastructure side of it. So in my opinion, the entire financial sector, the banking space is looking very, very strong. The first preference today will be towards the larger private sector banks who've done just nothing over the last 1.5, 2 years. And we've seen Axis Bank reporting good numbers and getting rewarded. We've seen ICICI Bank reporting good numbers and getting rewarded. So larger private sector banks, then you can look at smaller private sector banks and ultimately PSU banks. That's how you should play it.
Yeah. Stay on with us, Aditya. And of course, Hemain, we spoke with a clutch of, banks today on their numbers, and we'll just play out slices of those conversations. You'll hear from IDFC First, IndusInd Bank and Utkarsh Small Finance Bank.
The good thing about our credit cost is quite low. For the segments we played, our credit cost is only 1%, actually 0.9%, 0.97% of the total assets of the bank, or 1.32% of the loan book, which is frankly quite low. And it's been like this. Many people say, guys, listen, your NIM is so high. Can you manage it like this? Well, it has been so like this for 13, 14 years. So we feel that we have a unique specialization in the segments we operate, and particularly in rural India, where we're focusing upon, the asset quality is just so good. Maybe people in rural India just want to pay. they're just more honest or God-fearing, God knows. But rural India repayment is superb.
Our growth, we've given a guidance of growth of 18 to 22%, and we've always remained in that range on our businesses. Our retail businesses, which are vehicle finance, JLG, continue to grow. Microfinance continue to grow at upwards of 18 to 25%, depending on which business you talk about. The reason why we are so confident about the growth is because we've diversified these portfolios. So vehicle finance is now not a commercial vehicle business. It also has personal mobility. And a large part of the book has come from personal mobility when the vehicle finance or the commercial vehicle slowed down. So we have a diversified portfolio in commercial vehicle, 8 categories of vehicle financing, which we do. And I think that's the reason why we've been able to sustain that growth.
So if you see, we have grown around 31% in terms of last year advances, and our trajectory will remain the same in terms of even percentage. We expect to grow around 30% plus for FY25 also overall advances, and we expect deposit growth to be higher than this, rather higher than previous year also. Previous year we have grown our deposits by 27%. I mean, our expectation is against a growth of advances of 30%. Our deposit growth should be 3 to 5% higher than the advances growth. If you remember, our H1 was a little slow. We had a lot of interventions, a lot of new initiative we had taken in Q1. So Q1 was a little slow, and we had started picking up from Q2 later, and actually from the Q3, and like December onwards.
All right, so that's the focus on banks and banking, and no doubt, I'm just going to quickly pull up the bank Nifty before we move on to the next sort of company and focus this afternoon, because it's just astonishing. And let's just get the line. Yeah, there you have the line chart as well. Bank Nifty is completely on a roll. Now, another stock that we're focusing on is Apollo Hospitals. Remember, they have a key deal out. We spoke with their CFO. There's a slew of brokerage notes also on what to watch out for. Shah joins in with the details.
Tamanna for that. So yes, the stock fell as much as 8.3% in trade today post agreement to raise equity of around 2,475 crore from Advent International and KeyMed merger. Now, while brokerages see the corporate action as a positive step, but the stock fell as the valuation was below market's expectation. Now, brokerage expressed concern about the valuation given to Apollo 24/7, which is lower than expected. So if you see, Motilal Oswal have maintained buy on Apollo Hospital at 7,280 target price, and they believe that the integration of Apollo Healthco and KeyMed to drive synergies over medium term. Motilal also noted that the partial stake sale in Apollo Healthco would provide growth capital for the company. Overall, the firm anticipates 48% CAGR earnings for the merged entity over the financial year 24 to 26. While Nuvama Institutional Equities noted that the $1.7 billion valuation of Apollo 24/7 was significantly lower than the estimated $2.7 billion, calling it a negative surprise and a huge letdown. Concerns were also raised about the doubling of KeyMed's valuation for the deal within a year. The brokerage said it seemed aggressive. Now, according to Nuvama, the fundraise could minimize 24/7's cash burn, support future expansion, and enable integrated pharmacy distribution. Meanwhile, if you see, Prabhudas Lilladher, who retained a buy call with a target price of around 7,000, acknowledged the discounted valuation, pointed out that stake sale of AHL to Advent was done below their estimate of $0.8 to $0.9 billion, but recognized the positive impact of the merger. And Prabhudas Lilladher pointed out the management guidance indicating an EBITDA of 2,000 crore for the merged entity by 2027 provides comfort. So these are all the brokerages that we have for Apollo.
So what the brokerages are saying is kind of getting reflected in the stock price as well, Varsha. So the concern with the KeyMed deal is the valuation at which it has been closed, and the stock 5% down nearly. It's lost about 300 odd bucks today. We spoke with the management. We spoke with the CFO actually of Apollo Hospitals, who talked about the market response.
So I think, I think this is an immediate reaction which has come from the market, and I think we should just respect that for now. But the point is, all the analysts were building in a number of 17,000 to 18,000 crores for the for the Apollo AHL business. But the way analysts look at it, they look at it as FY26, forward multiple, etc., to come at this number. If you look at the money which is coming in from Advent, which is a reputed private equity player who's coming into the business, it's coming in today. So clearly, money which comes in today, yes, it's coming in today at a valuation of 14,478 crores, so around 15,000 crores. I think, roughly around, 1,500 to 2,000 crores lower than what analysts were expecting. So I guess, and that's in some way, we'll have to understand that it was something that they were doing based on FY26 forward, whereas this is money coming in now. So, I think we will clearly see that from now on, as we look at the business, I think it's going to be significantly value accretive to the business. I am not overly concerned about the current stock reaction because, it's a deal which is a bit complex. People are trying to understand and assess what scheme it's going to do, etc. I think it's a normal reaction that the market is having, but we are quite sure that over the next few days, as people understand this transaction better, they will realize that the combined entity that we are putting together is going to be a powerhouse in the pharmacy distribution and omni-channel pharmacy business, which should only be significantly value accretive to the Apollo shareholders at large.
Okay, a view on both of these, a view on this from both our guests. Hemen, to you first. Off the lows of the day is Apollo, but certainly lower. What do the charts or the derivative positions suggest to you?
Oh, frankly speaking, the volume seems to suggest that the selling climax seems to have exhausted itself, Niraj. Because volume is humongous. We are 25 lakhs plus on the NSE cash. And this is probably the highest single day volume in more than a year. So I believe it's fallen off a cliff, but I think the worst is over. Assuming for the next 3 trading sessions, we don't breach today's low. So I'd say worst is over, and it doesn't look as if it's going to break. I mean, such volume, one would have to wait for the delivery marking. Neither.
Okay. Any quick thoughts here, Aditya? Were you convinced about the valuation argument that the management gave, or do you believe that that the stock has got the deserved punishment?
In my opinion, the valuation was lower than what market was really expecting. But hey, that's a short-term thing. Longer term, Apollo Hospital is a great franchise, and they are going to do extremely well, even with the hospital bed addition that is going to come up. So in my opinion, if you are a long-term investor on such great companies, this is an opportunity to add only if you have a time horizon of at least 3 to 5 years. Otherwise, you could really avoid the stock right now at this stage.
Okay, the other stock in focus is Supreme Industries. The stock has given a very big thumbs up to its results and the key details that came out on earnings. Puneet, tell us what's gotten the street excited for a 15% up move.
Yeah, as you rightly said, Niraj, stock hit an intraday high of 14%. Now, this is the highest level that the stock has traded at in the last 15 years. Now, what has driven it is the volume growth in the main plastic segments. Now, although revenue growth was high at roughly 16%, the estimates were roughly coming in at low single digits for revenue growth, which it has beaten tremendously up 16%. Although margins were down 215 basis points, the street has taken positive view on the revenue growth. Now, if you look at the volumes across its multiple divisions that the company operates in, the plastic divisions are roughly a 41% growth compared to the previous year, coming in at roughly 150,000 metric tons, while its other divisions such as packaging and industrials did decently well, but much lower compared to the plastic divisions, coming in at 2 to 11% revenue growth. While we look at how coming in at volume growth, so on the revenue basis, plastics have given roughly 22% growth compared to the previous year, coming in at 2,150 crores, while packaging is up 16%, while the others have done slightly negative revenue growth. Now, on EBIT margins, this is key to know that even though packaging had a really strong revenue growth, the margins haven't supported. They're down 500 basis points compared to the previous year, coming in at 14. While the industrial products segment, which is a smaller base compared to the other divisions, the EBIT margin has grown to 19% compared to 7% last year. So multiple divisions doing well on revenue as well as on EBITDA. So the brokerages also have a good view on the same. IDBI they have downgraded at roughly 4,786, but this is purely on valuation concerns. They have indicated that the management has given a strong guidance of roughly 20% growth in volumes next year, and specifically in the pipes division, they are expecting a 25% growth in the next year on a strong base. They are also going to be adding 2 new plants in Patna as well as Vijayawada, and they are expecting the brokerage is expecting long-term sustainable earnings growth supported by market share gains, while ICICI Securities has a hold rating at a target price of roughly 4,200. They have said that the blended margins increased quarter on quarter, which led to a strong revenue growth for the plastics, while demand has remained strong across housing, agri, as well as the infra segments. They are expecting 25% growth in price, and they have given a margin guidance of roughly 15.5%. They have also tweaked their estimates on the positive side by roughly 3 to 4%, and are strongly positive on the stock. So really strong earnings. Brokerages have also given up a thumbs up, and let's see how Supreme Industries perform in the next year. Back to you.
All right, they've already performed very well today, at least on the stock price, 14% up. Very quick take came in on Supreme after this up move. Do you see more steam?
Yes, absolutely, Tamanna, because it's taken time and price. A 6-month consolidation, then we see all-time high with this amount of volume. Yes, I think further upside, we're at 4,955. We are heading towards 5.5 or more, Tamanna.
And any quick BTST calls, Hemen?
There are a whole bunch of ones. I would say EU Small Finance Bank looks like a BTST.
Even now, look at the stock run up. You're saying it's even now a BTST call?
Yeah, I still feel it's a BTST call. EU Small Finance Bank, Tamanna.
Okay. And?
No, I think we're going to sort of cool off a bit from the highs. Probably it's just profit booking last 5 minutes. Even a HDFC Bank can be but then that would be focusing just on banks, Tamanna. So no, I would say one is enough. The market's going to cool off a bit from here.
Okay, we'll leave it at that. Gentlemen, thanks so much for taking the time out and being with us and giving us that perspective. That's the long and short of how the markets or the views of our guests are. But the markets will come up on your screen, of course, now. And a clutch of stocks have reacted and reacted duly. So I think we'll talk about all of those. Nifty is up about 1%, but the bank Nifty is the real star, led by ICICI Bank, no doubt. But HDFC Bank and some of the others participated as well, which is really a good sign. Bring up the Nifty Bank constituents, and you will see an ICICI Bank, an HDFC Bank, heavyweights. IndusInd Bank, we spoke to the management today, SBI, all doing well. HDFC may not feature in the list here, but if you look at the point contributors list on the Nifty or the Nifty Bank for that matter, you will see some serious contribution by those as well. ICICI Bank is number one, but HDFC is participating, and frankly, it's all about banks, because if you look at HCL Tech, if you look at Apollo, or if you look at some of the others, including the auto names, they've all looked slightly wobbly in the session today. Apollo down about 4.5%, HCL Tech down about 5%. And the heat map will effectively show you the same thing. HCL Tech, Apollo, maybe an HDFC Life on the downside here. Bajaj Auto 2 down about 2.5%. And on the flip side, it's all about banks. But I must say, UltraTech makes an impressive entry into the top 5. Posts the numbers up about 3%, as does Grasim move along with it. And in some sense, BPCL2 has had a good move. So that's the large caps. Tamanna, what about the broader end of the spectrum?
Yeah, so I would say again, a lot of excitement in the banking space. AU Small Finance Bank would be one big winner towards the end. Supreme Industries, and we spoke about that just as we closed. I want to see where BSE is ending up, because this morning BSE was the one with the most pain, and it's been a tough one. BSE continues to suffer. MCX as well, because both are recipients of this sort of big fee from SEBI, and that's hurting them, but MCX not as badly hit as a BSE perhaps in comparison. We should see what Trent is looking like. The numbers have come just a short while ago. Looks good on the face of it, but there is a one-time sort of factor in. That's why maybe a tepid response to a Trent as we speak. But it has been a day, I would say, of a downtrend for real estate. While everything else has done relatively well, IT and real estate, realty haven't to that extent. And if we could just quickly pull up the components of the Nifty reality to see what has hurt the most, I would guess a Mahindra Lifespace is on that list. As well, yeah, right on top. We spoke to the management, and Street is not too convinced with those revenue numbers falling, which the management says is part and parcel of the realty business, but Street doesn't seem to convince, at least today. DLF Prestige also on that list. Macro Tech looking relatively okay.
Yeah, KPIT Tech came out with numbers. I think I missed that, marking that at the start of the show, Tamanna, I did. But I think that stock too has reacted very admirably to those numbers, 6.5%. 1508 and counting, so really good coin.
Yeah, so that's pretty much it on India market close. We're wrapping a little in advance because we want to play out this very interesting interview for you, and we pull up the Nestle stock just as we go into it. Nestle, a stellar set of numbers, but bogged with some very, very negative headlines on the amount of sugar in their baby food. I had the opportunity to speak with Suresh Narayan, the CMD, on the financials and a lot more. Listen in to that interview. All right, Nestle in focus after a stellar set of numbers which came in last